guys, Brian Stevens over here. I've got Jim Neighbors out of Cleveland. Yes, that is a poster of Bernard Kosar in the background. If you don't know who Bernard Kosar is, you have not been following football for the past 30 years. We got a couple of great things we want to talk about and what NAMB is doing for you. So, Jim, how's your day?
It's a great day. We've had some great calls, some great meetings with people. Most of them have been related around government affairs, naturally, with what's going on in Washington, D.C., with not only the budget and how that's going to affect us, but also what's going on with Fannie and Freddie. And last week, myself and Valerie Saunders, our chief executive strategist, and Rocky Andrews, our chief financial officer, we were in D.C. for the CSBS, yes, held a mortgage summit where, not only did Congressman Flood talk about affordable housing, but Secretary of HUD, Turner, former NFL player, in fact, I believe he played for the San Francisco 49ers for a little while, if I'm not mistaken, spoke. So it was a very good conference, and we spent time there, lobbying for our number one issue, which right now is the home buying, I always call it trigger leads, but it's the Home Buying Privacy Protection Act, in the House and the Senate.
All right. Well, these are issues which, by the way, getting back into loans, trigger leads are crazy. I can't believe this is legal. It is nuts. Your third or fourth client is going to get hit up by people to where they have to turn their phone off. But I want to talk to you about this first. So we saw recently with Martha Fudge and we saw HUD basically taking their foot off the pedal, and they're moving over their toxic loans to private lenders. They're taking the onus of responsibility to where they now have 10% in their MMI account, their mutual mortgage insurance account. They've got over 10% in there right now, which is 5 times higher than the congressional mandate. And they're doing this because I think they see a flood of foreclosures in the future. Just 2 days ago, we saw President Trump talk about, making Fannie and Freddie public by, recapping and releasing what they're doing right now. But one of the people that he had on the stage with him was a guy named Alex Karp. Alex Karp is a good friend with somebody which basically rolls down to Elon Musk. And it kind of feels like a little bit of a good old boys club. And what they do is they've got software right now that basically categorizes what people do, and they're looking for defaults with Fannie and Freddie. And that feels like they're doing the same onus of responsibility, and they're dropping that on the shoulders of the taxpayers. Is this happening right now? And should we be concerned about it?
Honestly, you're the first person that's ever even told me about that. I'll get and we'll look into it deeper, but I haven't heard anything about
them using AI to go about and figure out, okay, who's going to go delinquent, who's not. And I don't know the gentleman you were talking about, but I think delinquency is always concerning, no matter what type of loan it is.
I see this right now, like with their G fee and how they've kind of used that money for other things, and it becomes a fun for them. Alex Karp is friends with Peter Thiel, who is friends with, who started PayPal with Elon Musk. And so there's 2 separations. There's 2 degrees of separation right now. And then the following day, the day after Trump said that he's going to recap and release Fannie Mae and Freddie Mac, is he came out and said, well, we're going to go ahead and take their company, this Alex Karp, we're going to take his company and we're going to use him, which is a weaponized form of software that gathers information, and their AI creates, systems and protocols that they can go ahead and follow. Now we're applying that towards Fannie Mae and Freddie Mac. I think this is the biggest issue in the industry right now. What do we do? I think the answer is pretty clear. We have to go ahead and just write clean loans. As long as we do that, we're going to be okay.
Yeah, like I said, I'm taking notes on this, and I'm going to have our people look into it, our lobbyists, give us an update on it. I've been on coalition meetings with the MBA, Brokers Action Coalition, independent community bankers, and no one has said this. You're the first one that has said this or brought it up. And even last week when we were with the, state banking supervisors, so there were probably 600 or 700 of them, nobody brought it up.
Well, I do think there is something to look into, especially considering the fact when Trump was talking about recapping and releasing that he had Alex Karp with him when he was doing this. I think there is something interesting. And what I love about you guys is that, yeah, you'll go look into this. Like, we have to find out, for our industry, my answer is like, just write clean loans. But what you guys can do is you could advocate on behalf of loan officers in order to make things kind of go more smoothly when they go forward. I think they're doing this just like what Martha Fudge did over at HUD. I think that they see a tsunami of foreclosures that are going to be in our future very, very, very soon. And when they do this, they don't want to be caught with a bill. And that's what all these moves look like to me. So what can NAMB do in that situation to where we can go ahead and we can protect your associate members, from like some of the CC&R issues that you might be facing? Like, where is NAMB positioned on this?
Like I said, one, I think we always want them to make the best loan humanly possible. But, nobody can control. There are a couple different issues that make up delinquency. One is, was the right loan made to begin with? Number one. But two.
That's a big one.
Yeah, that's a big one. But a bigger one, depending on the area you're in, what happened to the borrower since you made them the loan? I always go back to 2008 during the mortgage meltdown. I had $700 million I was servicing. I had $138,000 in losses. If those two people hadn't died, they would have been making their payments too. But if you remember, all the goofy loan programs that were being made in there, the 4-payment option arm, the Ninja loan, the Nina loan, all that crap. Now, we've done a great job in cleaning that up, but that still doesn't affect when somebody loses their job or their company decides to relocate to another state or in some cases another country. And they're just left there, okay, I bought this house. What am I going to do? How am I going to make the payments? I think part of that is, just when we look at delinquent loans, HR 1815 provide protection for the veterans that just passed.
4 weeks ago, we met with the Democrats in House administration one day, Veterans Affairs one day, the Republicans the next day. They introduced a bill. They got together and said, okay, here's what we're going to do. And they put a plan together. Now, the Senate hasn't taken it up, but the Senate says
the VA already had the ability to do exactly what they've been doing during COVID, which was to extend, that delinquency that the veterans had gotten behind. They felt, the Senate believes that they have the authority to do the decision they had that the president, pulled when he pulled VSAP.
Do you feel like this administration is positive in terms of what we're doing, what we're trying to accomplish? Do you feel they're helpful?
Yeah, I think so far Pulte has been, one, I think he understands the housing industry, which is always a good thing.
You better.
Think you mentioned Martha Fudge, but think back to Dr. Ben Carlson when he was the Secretary of HUD. I also think Turner has an understanding of housing. So I think that's an advantage to us to have people that understand it. But we've been in receivership for 19 years, okay, in conservatorship. It is, but they've made a lot of money on it too.
Well, they made $28.9 billion this year with
that's just Fannie. Freddie made another 12 billion.
They made 11.9. Fannie made 19 billion. Fannie made 11.9. They made $29 billion between the two of them, which make them the richest company in the country. Honestly, I kind of vacillate on this whole thing. I go back and forth. I think that maybe conservatorship is a better place for them to be right now. Like, are you concerned about them going public? I mean, I am.
Well,
we might see rates go up by like another point to a 1.5.
Concerned about the interest rates going up. Also concerned about who buys them. Okay, my son I used to let him play with some of his college funds, but the one deal is you had to buy Fannie Mae. So he owned Fannie Mae stock, wrote it all the way to the bottom. But I'm concerned when the Corker bill came out. The first time when they were trying in the early 2000s when they were trying to get it, 2015, I think they were trying to, put a bill out to set them free. But the one thing I didn't like, there's two things I didn't like. One was the idea is the government, whoever bought it, the government was going to insure them against any losses.
Well, I mean, Trump came out and he said he's going to get the implicit guarantee from the federal government and he's going to make them public again. Okay, so we like the implicit guarantee. I mean, that's how it's always been for the nearly 100 years that they've done this. But if they make them public and the Federal Reserve doesn't go out there and buy all the mortgage-backed securities, then what happens to rates? Like, my concern is that this is a knee-jerk reaction, and I don't necessarily think it's going to be in the best interest of home buyers, because right now, nobody can buy a house anywhere. Like, that's the idea. But if we had rates, in the low sixes, and, you have the Federal Reserve who's going to raise their balance sheet and they're going to go out and buy everything, then, of course, we get closer to that. What does the next 6 months look like?
I don't think they're going to be able to move. It's not like, okay, we're going to set them free. It's getting out of conservatorship is not going to go as quickly as putting them into conservatorship. But I mean, you have to start talking about it eventually. You just can't just say, okay, off they go. I mean, I personally think, the President Trump says they're worth about $300 billion. I'm like, well, wait a second. You could make that money pretty quickly if you just kept owning it. I've heard different rumors, like, they're going to do away with them completely and set up something similar to the Federal Reserve, the Federal Mortgage Insurance Corporation, where every lender will have to pay, to insure, just like the FDIC insures, the banks, so that they don't lose money. And, I'm waiting to hear more information on how that would work. But I do think that, it's been profitable to the government. I think the biggest concern when Corker the biggest concern I think mortgage people had was they're going to get bought, the Fannie and Freddie are going to get bought by the Big Five. And then there'll be one set of pricing for the Big Five and one set of pricing for everybody else in the country. Par for the Big Five is going to be less than it's going to be. You and I are going to be a par plus one.
Now, who's the Big Five?
I'm talking about Chase, Wells, all those guys. The too big to fail banks.
You're talking about people who, by and large, are no longer in the mortgage industry. They want nothing to do with this because it's become too prohibitive for them to be a part of it because they get sued too often.
Unless they own the industry.
So you think they're going to jump back in and be a big part of it?
That was my concern back then. My other concern would be the president says it's worth $300 billion. What countries can afford to write checks for $300 billion?
Yeah.
I don't like the idea that the American housing market would be controlled by a foreign country. So I think there's so many tangible things that they need to work out, because Saudi Arabia could just write a check for $300 billion. If that's what they think it's worth. I think it's worth much more than that.
Well, the U.S. housing market and the implicit guarantee between, Fannie, Freddie, and Ginnie loans is about $50 trillion.
Yeah.
This is my big thing, and this is where I think NAMB could be such a huge part of it, is that I think the answer is with mortgage brokers. I do. Because we're in every community, and one thing that we can do that nobody else can do is I can stare down the line of the high school football game and say, hey, Sally, how's Johnny doing? He's doing good. How are you doing? Like, we have that personal connection with our communities on a day-by-day basis, and that matters. It's in Cleveland. It's where you live. It's where I live.
It's funny you should say that, because I just wrote my article for the June magazine and sent it in yesterday. My wife, actually, she's a retired teacher, so she's proofing in it, and she goes, you certainly talk a lot about how the mortgage broker lives in the communities, knows the people, understands their situation when they have a problem, that, a big group of other people, they're just a number. They're just a phone number. What's your account number? Whereas you're seeing them, I'm in McDonald's and I'm seeing people that I do business with. And I think that's what mortgage brokers do bring. So she said, so basically you geared a whole article about how you should just deal with the people that that you feel comfortable with, that also understand what your deal is. Like what's going on at the Chevrolet plant, or what's going on at LTV Steel or United Steel. And I'm like, yeah, that's what mortgage brokers are. They're just, we, on top of, besides we represent 9 different companies that you could tailor a loan for them better, but we understand the people because we live the exact same lives they're living, so I think that's a huge advantage to us. But I do think, I do like the fact that they're at least looking at it and saying, okay, what are the options here? And maybe the option is going to be, you know what? The best thing to do is just do exactly what we're doing. It may be, all right, we're going to keep doing what we're going to do, but let's restructure how we're looking at loans and how we're underwriting loans. The idea that HMDA data is now 48 items, and it used to be 8. Is it really, are we over-regulating people? Are you putting people out of business because they can't just handle the compliance issues anymore?
And I think this is where NAMB really has a chance to like shine.
Yeah, this is one besides, I think, we do an excellent job of trying to educate everybody that wants to be in our industry, whether they're a member or not. I think, we're trying to look ahead and say, okay, what's the next step for this? What's the next step for that? How do we help make this better? And the first decision isn't what's in the best interest of the owners of the company. It's what's the best interest for the industry, which means what's in the best interest for our borrower, because those are the people that we're gonna be around. So we don't want to mess that up. So whether, it's like, okay, what type of loan should you get? Should you get a VA loan, FHA loan, USDA loan? What's, tailoring a loan program to them. And FHA has been successful. USDA has been very successful. Federal Home Loan Bank programs have been very successful. And it's just, okay, who represents, gives you the opportunity to have all those different programs. And that's what mortgage brokers do. It represents that part of the industry.
It's so funny you say that. I have a borrower right now. He was buying a residential place. Turns out it's commercial. It's a crop duster. He's a bank statement loan. He's buying a modular home. He's buying it non-owner occupied. Risk, 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 risk. Now the rate is 10.5%. We actually called the USDA on this thing to see if there's like any other programs that we could do. But the rate is going to be what the rate is going to be. What our borrower is doing is he's shopping it with a local bank. I'm like, they don't understand like all these modular, non-owner occupied commercial land. And I think we could actually go in and kind of fight for like the idea that this is commercial, because it seems kind of residential to me.
Right.
My partner, Joanna, her dad was a commercial appraiser, and he goes, oh, he was a crop duster. And it was like, oh my God, that makes sense. And he bought this land and he bought a commercial. But what we're going to do as brokers is we've shopped it to 35 people. We know that we have the best rate. Right. And this is kind of what brokers bring to the table. We just don't write the meat and potato kind of everyday loans. What brokers do is we write the hard loans. We write the complicated loans. We go out there and we run the distance. And I think that's what people need to understand, right?
I don't think, unlike a lot of lenders, mortgage brokers don't walk away from the deal because it's just too hard to do. We look for a way to make every loan. Now, there are some loans that can't be made. All right, and to me, the number of reasons they can't be made is if the borrower can't afford to make the payment. I mean, that's the first thing. On my first day of Transamerica in '76, they said, okay, we don't lend money to anybody who can't make the payment back. Well, that makes perfect sense.
Really?
Oh, that was the first on day one.
Really?
The first thing out of their mouths was, we don't lend money to people who can't pay us back. Then you actually, as part of their training program, you spent the next 3 months collecting. So you knew, all right, so when you actually had some loan authority, okay, I see the situation, we won't duplicate the situation. But to me, even I've argued with people, well, their FICO score is huge, their LTV is excellent, this is going to be great. I'm like, sure, if they only had a job, how are they going to make the payments?
But I think what you're saying is as a mortgage broker, unlike a banker who only has like one option on the table, is we could go ahead and we could mitigate risk overlays.
Yeah.
And so I have 4 overlays. Let's go find somebody with 3. Let's go find somebody with 2. And we have the opportunity to go out there and like shop a loan where other people don't. And what mortgage brokers are is we're in every community. We're all over the place. And this is what we do well when we're at our best. And I'll tell you this right now. I mean, you would agree. When you do a good job out in Cleveland, you help me in California because somebody says, oh, I got a great loan, from Jim. And you help me out here because reputationally, we're all kind of aligned. And that's my big thing right now. And what we have to do as an industry, particularly the brokers, because in 2008, the term broker became simultaneous with anybody who wrote a bad loan. And the last I checked, we never underwrote anything. But we became commingled with everybody who wrote a loan. And I think what's happening with the broker channel right now is I think that it's picking up steam because, yeah, we have the ability to do that. Even I sit here today with 30 people that I looked at on a loan that I'm dealing with right now, and maybe it's 31 who might give me a point better. I don't know, but I have the ability to shop that as a broker. And I think we have such an incredibly dynamic industry, and we have to make sure that we are great stewards of it.
And you're right. During the mortgage meltdown, we got a lot of the blame.
We were originating between 60 and 70% of all the loans nationwide.
Yeah.
But the other thing is we didn't approve the loans. We also didn't develop the loan programs.
Yes.
And people keep forgetting, we didn't invent the 4-payment option arm. We didn't invent the no income, no asset loan. We didn't invent any of these.
Great point.
Okay, they were put out there, and it's like, okay, by fair lending laws, if these are the programs available that with the company that you're working with, you can't say, all right, no. So, all we did was offer the programs that they developed. I think enough safeguards have been put in place so that won't happen again. Now people have other problems that are going to like the 4-payment option arm or the teaser rates. Remember the teaser rates where this is going to be your payment for 2 years, and then it's going to jump 5%. Well, guess what? In the 25th month, you can't make the payment. You're not even close because you went from a 3%, now you're at 8, and you really budgeted at 3. I mean, so all those safeguards have now been put into place and keep the industry, not just us, but the entire industry. We all understand what the rules are, but it still comes down to, as they said in 1976, we don't lend money to people that can't make their payments. And I've had close friends that are like, I don't understand why that's your first rule. And I'm like, it just always has been. It makes perfect sense.
Hey, listen, I'll tell you right now, guys, if you want to see NAMB advocate for you, and Jim Neighbors, I've known him long enough. He's the guy. He's the right guy. Do me a favor. Get out your pocketbook, go out there, grab your credit card, and pay the $40, the $60, the $100, whatever it is, jump on and be a part of it. If we double or triple our numbers, they have much more better advocacy when we have these conversations, when we can show numbers. And that gives them the latitude to go out there and do the things that we need to do. Now, I'm not giving these guys a break at all. None. But they're doing the right job. I just closed a deal last month, and I made $16,000 on a goddamn deal. It's ridiculous. So what we have to do is spend the nominal amount of money and be a part of what these guys are doing because they are the only voice. And I'm telling you, it's not the NBA. I love the NBA. They're great at what they do, but they're not me and you. If you want the small guy on the street who's a broker out there going and kicking ass, it's you. It's NAMB who's doing it. And they've got a tailwind right now that is working for them. But with your help, they get better.
I think in the next, we actually have a plan where you can pay by the month. That you can make monthly payments. And I'm just going to tell you and your entire audience, the next 60 days, there's going to be some great things happening for our industry, that are moving through. That one, we met with the FHFA a little over a week ago. We were the ones that started talking to them about credit bureaus.
Which, by the way, is bullshit.
Yeah,
Did I have to pay $85 for a credit report right now? It's crazy.
Yeah, it's kind of interesting because back in 2016, it was only 40. Now it's 100 going up. And even we brought up the fact that and had a conversation with them. Originally, the reason you get a tri-merge is because they were all locally owned credit bureaus. There was a Cleveland one, a Columbus one, a Toledo one. And you weren't required by law to report, a lender wasn't required by law to report to more than one. So they changed the law, so they required a tri-merge. So you got all three. But now the law's been changed, so you have to report to all three of the repository. So at what point do you no longer need a tri-merge if you already got the rating in there from PNC Bank, from TransUnion? Why do you need the exact same thing would be coming out of Equifax or Experian? It doesn't make any sense. So I think, they're looking at that. They're also looking at kind of like similar, and for the government to say, well, that's how we've always done it. Well, before COVID, did you ever hear of anybody getting an appraisal waiver? No. But guess what? What percentage of loans do you get our appraisal waiver now?
20, 30?
Yeah, because of the collateral underwriter that Fannie and Freddie put together so that they have millions of appraisals so that when they put in your address, they know exactly what those homes are selling for in that neighborhood. So they'll know. It's like, okay, if you can do that with an appraisal, why can't you do it with the credit bureau too?
Yeah.
Why can't you make the change there? But I mean, these are things that when I talk about, Director Pulte, these are things that he's listening to people in the industry and going, you know what? Yeah, a lot of this doesn't make sense. How do we make this better?
I mean, I honestly, when I heard Pulte's name, I snickered. I'm like, this is bullshit. But I've seen him in action. I kind of like him. Like, his actions have been good. Like, right now, don't you find him favorable?
Yes, I would.
Yes, me too.
I think everybody was, I came into it and I'm like, one, the guy knows the housing industry because he's a builder, or at least his family's a builder. So let's see, what he does. And I haven't seen anything that he's done that,
No.
promoting the idea that we got to make housing more affordable. Okay, in as many ways as possible. And I'm like, okay, let's look at the cost of credit. Let's look at all the costs that are involved. And at the same time, I think he recognizes, as you've kind of emphasized, the value of a mortgage broker, an independent who can deal with more than just one bank. Here's our program. You either fit in the box or you don't.
Yeah, no, I saw him as a good old boys club. I'm like, oh my God, this is not going to be good. But like every move he's made, just to be honest, like every move he's made, I think has been really positive. And he has shown the capability of like reaching out and like listening to what we have to say, which makes NAMB even more important. And I like that about him. Again, my knee jerk was no. But everything he's doing makes everything we're talking about more critical. We have to have these conversations because they're willing to listen, and they've shown the propensity to do that, over the past year or 8 months or whatever it is. Like, I kind of like the guy.
I don't want to say people were pleasantly surprised, but I guess people are pleasantly surprised. This is what he does kind of for a living too.
Well, from a new home builder standpoint, I thought he would be much more in bed with them, but he's been as transparent as you could possibly hope for from anybody. And again, he's shown the propensity to reach out to people like me and you. I do like that about him, and I think that really kind of serves us well. Which, again, I'm just going to say this one last time, it's much more reason for you guys to reach out and be a part of NAMB. Because when you sign your name to that ledger and you become part of what NAMB is doing, what you do is you put another voice behind, the fella who's going to be Jim Neighbors, who's carrying the flag up the hill. It's just that simple. And the more voices we have, the better our business is going to be. And I think we all understand this. We all understand we truly want cheaper rates. Like what we're paying right now is just exorbitant. NAMB's got all these issues in their front lines. They're working on them on your behalf right now in Congress every day, and just be a part of it. Like I said, spend your $40 of your $10,000 check, spend your $80, $100, whatever the hell it is. Just spend the money and do it. And you understand what you're doing is you're investing in your ability to go out and do your job, because us as brokers, and I write loans every day now, when we do this, we service our communities. We just do. We make things go well. Every one deal that comes in, I think I heard it was like $80,000 is brought from every transaction, from all the people who touch it. And when that money is recirculated in your community, it's the lifeblood that keeps things going. Sure. You guys serve a purpose that's bigger than you. You make your town better. And you need people like Jim and like NAMB. So Jim, dude, love you to death. Seriously. Outside of Bernie Kosar, think you're great.